Good afternoon. The South African economy recorded positive growth during the second quarter of 2017, following 2 consecutive quarters of contraction. Growth prospects, however, remain subdued as domestic fixed investment contracted further amid low business confidence. The inflation forecast has increased marginally since the previous meeting of the MPC, with increased uncertainty regarding a number of the main drivers. The global economy is on a recovery path. Inflation has moderated in the emerging market economies and remains benign in most advanced economies. The FOMC statement yesterday confirmed the gradual pace of reduction of its balance sheet and normalization of its policy rate. Along with continued accommodative policies by the ECB, this is expected to contribute to the continuation of favorable prospects for capital flows to emerging economies. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas increased to 4.8% in August, up from 4.6% previously, marginally below the bank's short-term forecast. The food and non-alcoholic beverage inflation surprised on the downside, moderating from 6.8 to 5.7%. Meat prices continued to accelerate in August, having measured 15.0%, but the lower cereal prices contributed to the slowing momentum. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 4.7% in July and 4.6% in August, in line with the short-term forecast. Year-on-year producer price inflation for final manufactured goods declined from 4% in June to 3.6% in July. Food products price inflation moderated further to 3.3% in July, but the divergent trend of manufactured meat prices continued with an increase of 17.8%. This trend was also evident in agricultural prices, where the subcategory of live animals increased by 31.7%, while products of crops and horticulture declined by 26.9%. The bank's forecast for headline inflation, CPI inflation, is unchanged at an annual average of 5.3% in 2017 and revised up by 0.1 percentage points to 5.0% and 5.3% in 2018 and 2019. The lower turning point of 4.6% is still expected in the first quarter of 2018. The same pattern is observed in the forecast for core inflation, which is unchanged at 4.8% for 2017, but adjusted up to 4.9% and 5% for the next 2 years. These forecasts do not incorporate the most recent inflation outcome. The main drivers of these changes are a lower repurchase rate, a less appreciated exchange rate assumption, a slightly narrower output gap, and a marginal adjustment to the food price forecast as meat prices continue to surprise on the upside. Food price inflation is forecast to reach a low turning point of 4.8% in the first quarter of 2018 and to average 7.3% in 2017 and 5.2% and 5.6% in 2018 and 2019. There may be some downside risk to this forecast in light of August food inflation outcomes. The electricity tariff assumption remains unchanged at 8.0% from July next year, but there may be some upside risk to this assumption given Eskom's recent application to NERSA. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the third quarter of 2017, continue to be relatively anchored at the upper end of the target range. Despite a decline of 0.2 percentage points in the average expected inflation for 2017 to 5.7%, expectations remain unchanged at 5.8 and 5.9% for the next 2 years. Expectations of analysts and business people moderated, although the latter remain above the target range, whilst those of trade unionists increased marginally. A welcome development is that average 5-year inflation expectations declined from 5.9% to 5.6%. This is the lowest level recorded since long-term expectations were first surveyed in 2011. Expectations implicit in the difference between nominal bonds and inflation-linked bonds are more or less unchanged since the previous meeting, with the 5-year break-even rate at 5.2%. Global conditions remain generally favorable despite some geopolitical risks. The upswing appears to be synchronized with increased world trade volumes. Growth in the US is forecast to remain above potential in the short to medium term, with the devastation caused by the recent hurricanes expected to have only a limited and short-lived impact on growth. The improved growth performance in the euro area also appears to be sustained and region-wide, while the Japanese economy has experienced moderate growth in the past few quarters. By contrast, growth in the UK has slowed, following weak investment in the face of the Brexit headwinds. The outlook for emerging markets is also relatively positive amid generally improving fundamentals. Despite the improved growth outlook, global inflation pressures remain benign, particularly in the advanced economies. These trends are likely to contribute to the persistence of accommodative monetary policy stances in Japan and the euro area, where the recent appreciation of the euro is likely to dampen inflation pressures further. As expected, the US Fed yesterday announced a gradual reduction of its balance sheet. The process has been communicated previously and was largely priced in by the financial markets. The pace of policy rate normalization is also expected to remain measured as inflation continues to surprise on the downside despite tightening labor market conditions. The stance of US fiscal policy is a source of uncertainty. Although tax reductions could lead to a faster pace of monetary tightening, the prospect of significant tax reforms has receded over time. The rand exchange rate traded in a range of between 13 rands 54 cents and 12 rands 74 cents since the previous meeting of the MPC, driven in part by movements in major currencies. Over this period, the rand depreciated by 2.8% against the US dollar, by 6.2% against the euro, and by 4.5% on a trade-weighted basis. The rand remains sensitive to political developments, weak economic growth prospects, and the risk of further sovereign ratings downgrades. However, it has been supported by persistent trade account surpluses and associated narrowing of the current account deficit. The rand has also been supported by the relatively accommodative global monetary policy settings. These have contributed to sustained demand for high-yielding emerging market bonds. Net purchases by non-residents of South African government bonds have amounted to 63 billion rand year to date. The domestic yield curve, relative to other peer emerging market economies, remains attractive to non-residents despite a decline in the curve across all maturities. However, longer-term bond yields and the rand remain vulnerable to a large non-resident sell-off in the event of further credit ratings downgrade, resulting in South Africa falling out of global bond indices. The domestic economic growth outlook remains constrained despite the higher than expected growth outcome of 2.5% in the second quarter of this year. This broad-based improvement, whilst welcome, is not expected to have a significant impact on the annual growth outcome. The bank's forecast for GDP growth for 2017 has been revised up marginally from 0.5% to 0.6%, while the forecast for 2018 and 2019 have remained unchanged at 1.2% and 1.5%. This outlook is consistent with the bank's leading business indicator, which has been weakening since the beginning of the year, indicative of muted growth prospects. Business confidence also remains at very low levels, despite the slight improvement in the RMB BER Business Confidence Index during the third quarter. All the major sectors, apart from construction, recorded positive growth in the second quarter, with a particularly strong performance in the agricultural sector. The recovery in the manufacturing sector followed 3 consecutive quarterly contractions, while the tertiary sector reversed its one-quarter contraction. The limited monthly data for the third quarter present a mixed picture at this stage. Manufacturing output contracted in July, while manufacturing recorded positive growth. However, the ABSA PMI has averaged 43.5 index points in the first 2 months of the quarter, suggesting continued headwinds of the sector. The underlying weakness in the economy is evident in the 2.6% contraction in gross fixed capital formation during the second quarter. Of particular concern is the 6.9% decline in private sector fixed investment, reflecting the low levels of business confidence. This subdued outlook is expected to persist against a backdrop of continued political and policy uncertainty. These investment trends do not bode well for employment creation in the economy. Total employment declined in the second quarter of 2017, and the unemployment rate remained unchanged at 27.7%. The public sector, previously the main source of employment growth in the economy, is likely to continue to shed jobs as fiscal constraints intensify. Consumption expenditure by households rebounded strongly in the second quarter, following the sizable contraction in the previous quarter. Spending on all 3 major good components recovered, but expenditure on services contracted. Despite the improved outcome, the outlook for consumption expenditure growth remains subdued, although positive, amidst very low levels of consumer confidence. Month-on-month retail trade sales decreased in July, but motor vehicle sales remained relatively strong in July and August. The bank expects household consumption growth to be in the region of 1% for this year. The underlying drivers of household consumption expenditure remains unchanged. Lower inflation, lower interest rates, and higher real income growth are expected to provide some support for consumption. Offsetting effects include depressed consumer confidence, weak employment growth, the absence of significant wealth effects, and the prospects of further tax increases in the wake of fiscal revenue shortfalls. In addition, growth in credit extension to the private sector has declined steadily over the past few months as corporate demand for mortgage finance and general loans in particular moderated. Growth in credit extension to households remain weak and negative in real terms. These trends are also reflected in continued household deleveraging, with household debt to disposable income declining further to 72.6% in the second quarter, its lowest level since the beginning of 2006. International oil prices have increased by about $5 per barrel since the previous meeting, with Brent crude oil currently trading at around $55 per barrel. Nevertheless, the MPC does not expect a further sustained acceleration in prices as the flexibility of US shale oil production is expected to provide a ceiling to prices. The previous oil price assumptions, therefore, remain unchanged. The domestic price of 95 octane petrol has increased by a cumulative 86 cents per litre since August, mainly due to higher international product prices. A further moderate increase is expected in October. The MPC expects inflation to remain within the target range over the forecast period, closer to the midpoint than was the case early in the year. Core inflation has remained relatively stable, indicative of the absence of significant demand pressures. However, a number of risks to the inflation outlook have increased, and the MPC assesses the risks to the inflation outlook to be somewhat on the upside. The rand remains a key upside risk to the inflation outlook. Furthermore, some of the event risks, particularly those of a political nature, are now more imminent, but with no greater degree of clarity regarding the outcome. The prospect of a further ratings downgrade persists, particularly given the increased fiscal challenges and political uncertainty. The narrower current account deficit and the global environment remain supportive of the rand. However, should inflation and/or growth surprise on the upside in Europe and in the US in particular, we could see a faster pace of monetary tightening, which could impact on capital flows and the rand exchange rate. At this stage, the markets appear to be pricing a high probability of an increase in federal funds rate in December and 3 further increases next year. A further upside risk relates to the possibility of a large electricity tariff increase than is currently assumed in our forecast from July next year. A tariff increase of 20% could raise the headline inflation forecast by between 0.2 and 0.3 percentage points, and the MPC will continue to assess the possible second-round effects of these increases. The MPC remains concerned that inflation expectations of business people and trade unions remain above or close to the 6% for the next 2 years, even though our forecasts and those of most analysts expect inflation to be much closer to 5%. Lower inflation expectations among key price setters is an important element in reducing inflation in the future, thus enabling lower nominal interest rates. Until August, food price inflation has been moderating at a slower pace than expected, mainly due to the continued acceleration in meat prices. However, the August year-on-year outcome surprised significantly on the downside. Should this lower trajectory continue, there could be a downside risk to the food price forecast and to the overall inflation outlook, particularly in the short term. Although household consumption expenditure rebounded in the second quarter, the MPC does not view this as indicative of the longer-term trend of expenditure, which is expected to remain constrained. The second quarter growth outcome, while positive, does not change our growth forecast significantly, and the outlook remains weak. The MPC assesses the risks to the revised growth forecast to be slightly on the downside. In light of these developments and the deteriorating assessment of the balance of risks, the MPC has decided to keep the repurchase rate unchanged at 6.75% per annum. 3 members preferred an unchanged stance, and 3 members preferred a 25 basis point reduction. Ultimately, the committee decided to keep the rates unchanged. Given the heightened uncertainties in the economy, the MPC felt it would be appropriate to maintain the current monetary policy stance at this stage and reassess the data and the balance of risks at the next meeting. Thank you very much for your attention, and at this stage I would like to turn over to members of the media for questions, and as usual, please identify yourself and the media house that you come from, and this distinguished panel will deal with your questions. Ma'am in a maroon top.
Good afternoon. I'm Amogelang Bata from Bloomberg News. Governor, given that you said there was a split between keeping the benchmark rate unchanged and a possible 25 basis point increase, are you able to share with us what some of the key reasons why the unchanged seemed to win the decision of the day, particularly because the SAB's forecast of the CPI remain within the target band at least until the fourth quarter of 2019? Was there absolutely no room for rates to be cut at this point in time?
The gentleman in a grey shirt.
It's actually spotted blue, but nonetheless, Governor Arabile Kumete from Bloomberg News. Governor, estimations in in today's statement reveal that you said you haven't taken yesterday's CPI figure into account. Had you taken that into account, would it have changed anything? And at the same time, I'd also like to ask with regards to, I'm going to say a really important matter overall. Has the Reserve Bank met with KPMG over the bank saga in any particular way to find out how South Africa's banks are doing as well? Thank you.
Any other question? We will come back to the competing central bank later. Let's deal with
Good afternoon, Governor. Tsepo Mongwa, SABC. Are there any indication, perhaps, that the market could be pricing in credit downgrade that would eventually lead us to being kicked out of the global bond index?
the gentleman in a black shirt.
Good day, Governor, and to the MPC. I just wanted to ask, does the bank
Your
still...
name, please?
Oh, sorry, Mfuneko from Reuters News. I wanted to ask, does the Monetary Policy Committee still see the exchange rate pass-through effect on inflation still subdued, or has that changed materially? Thanks.
The reasons why we have decided to hold rates the same are in the statement. There is nothing further to add to what is in the statement. And those reasons are the collective view of the entire MPC, irrespective of whether you preferred a cut or whether you preferred that rates stay the same. So the decision remains that of the committee. Arabile, we can't ignore the most recent CPI. We took it into account. The only thing is that our forecast would not have incorporated yesterday's outcome. Remember, yesterday's outcome was only 0.1% below what we had at the previous MPC. So that is no big deal. That is our near-term forecast for the month. What matters is the horizon. There is this thing, Arabile, that we get excited by the most recent CPI reading. That tells me nothing. That is in the past. What matters is what is inflation going to be within the policy horizon? And the policy horizon is between 12 and 18 months. And when you look at the policy horizon of the 12 to 18 months, you will then realize that we have only revised the CPI upwards by 0.1% in 2018 and 2019, whilst we kept it the same for 2017. Tsepo, are the markets pricing the possibility of a credit downgrade? It will be really good if they have priced it in. Because if they have priced it in and it doesn't happen, that means that it will be positive response for South Africa. But if they have priced it in and it happens, that means that there is not going to be a movement in markets. However, if they have not priced it in and it happens, then we are in all sorts of troubles, because then we must figure out what will happen to the capital flows, what is going to happen to the exchange rate, what's going to happen to South African financial assets, and so forth. And a combination of all of those, how does it fit into the inflation rate? Does it lead to second round effects? And if it leads to second round effects, monetary policy has got to react to those second round effects. So it's still the same answer that we had been giving for the past 2 years, I think. Mfuneko, the exchange rate pass-through, do we still see it as muted? Generally, when you look at emerging markets, everyone says that the exchange rate pass-through have been muted. There is a disagreement amongst economists as to why they are muted. They vary from emerging market countries now have got credible central banks, and because they have got credible central banks, the price setters believe that if inflation goes up, the central banks will act. They also go to the extent of saying that, well, the pass-throughs are muted because inflation in the developed world is actually benign. And because inflation is benign there, even when the exchange rates depreciate, you do not have significant pass-through in terms of imported inflation, because inflation in the developed economies is actually so low. Arabile, KPMG was not the subject of the MPC discussion. If you are interested at the end of the MPC press conference, we might just deal with that question. Are there any other questions? Okay, let's go to the competing central bank here.
All right, there you go. The Reserve Bank Governor, Lesetja Kganyago, announcing the latest interest rate decision. It's staying steady. The prime lending rate 10.25%, and of course the repo rate staying steady at 6.75%. We'll find out why, try and tackle all the reasons when we come back. First, an ad break. See you in a moment.
What guides us? What leads us forward? Is it the advice of our elders? Is it the actions of our people? Or the voices of our citizens? Your country is guided by the voices of its people, and your broadcaster is dependent on your voice to guide it. Get your copy of the SABC's editorial policy and have your say.
We take an in-depth look of all your stories of the day across the world.
Last month, Mkhwebane said that the bank had failed in its duties to protect the public by not ensuring that ABSA repaid an apartheid-era bailout given to the failed bank, Bank Corp. The rand fell nearly 2% on her remarks.
My effort, in my opinion, is going to be to build a Zimbabwe that I believe in, as opposed to remaking a Zimbabwe of the past that I cannot do anyway. So I'm absolutely clear on this.
We need to start showing more commitment by government that they are committed to working with business.
Welcome back. It's a special broadcast of the latest Monetary Policy Committee decision on interest rates from the Reserve Bank. We've just heard moments ago Reserve Bank Governor Lesetja Kganyago holding interest rates steady. It stands at 6.75%, which means your prime lending rate at banks, 10.25%. Well, two economists to try and dissect exactly what the statement is telling us from the Reserve Bank. From Argon Asset Management, Dr. Tabi Leoka, thanks for coming in. and senior economist at FNB, Mamelo Matikinga. Thanks very much indeed for talking.
It's a pleasure.
All right, so Mamelo, let's start with you. I was saying during the break that just largely speaking, there was an expectation for the governor to cut interest rates today. It didn't happen.
Yeah, as you rightly mentioned, expectations was for a cut, but I think there was always recognition that the members might be at odds about the timing of the interest rate cut. And I think the fact that the bank hasn't had enough time to incorporate the latest inflation figures into their model also points to why I think the decision was a bit difficult to make at this particular point. I think the governor emphasized quite a bit in the statement that the risks to the inflation outlook are on the upside. And it would have been interesting to get a sense of what their expectations for the electricity tariffs are for next year, because ultimately that has quite huge implication for the inflation profile for 2018. He did mention that if there is a 20% increase in the tariffs, that could potentially lift the inflation rate by 0.2 or 0.3%. And I think the fact that food prices as well, they haven't actually incorporated that into their model. It would have been quite interesting to see if there is any major changes in the inflation profile. But as it stands, I mean, when I look at our forecast, it does seem as if they're not sure at this particular point in time. And I get the feel that the market is expecting a double-digit increase in electricity next year. We certainly have around 10% penciled in right now because we don't have enough information. And that does have a huge implication for the profile later on in 2018. But if we look at inflation, I mean, from October onwards, we're expecting it to be below 5%. And, perhaps, once the SARB gets more information around November, they will be in a better position to make, a decision. Because if it's not November, my feel would be that then they won't move.
It will never come. Tabi, what do you think about the fact that he spent a lot of time talking about the risks to inflation?
Yeah, he talked about the currency risk. He mentioned the risk to the risks associated with ratings downgrade. He talked about the risks of outflows should there be an increase in rates in the US. He talked about also the risk of if you see increases in GDP in Europe and in the US, obviously that makes those countries more attractive, and that could lead to outflows as well. But at the same time, he talked about, inflationary expectations coming down. He talked about, the inflation is still way below the upper limit of the target band. I feel that he should have actually cut rates because this cycle is going to be very shallow, given the risk. And the risks are not short-term risks. The risks are more medium to long-term risks. And in order for us, given especially, I know that growth is not the responsibility or the sole responsibility of the Reserve Bank, but given that we have very little in terms of stimulus, I think that, cutting rates further would actually support economic growth, at least in next year and in 2018. So I felt that they should have taken advantage of this opportunity, cut rates in November, and then wait and see what happens in December before making a move in January.
Yeah, that's a very interesting point. I mean, I think that also went along with expectations, didn't it, Mamelo? This concept of front-loading your interest rate cut, because by his own words, electricity tariffs are going up. Come mid-2018, you're going to see inflation emerge again on the upside. Why do you think he didn't do as Tabi recommended or suggested, cut now because inflation's going to change mid-next year?
I think, as you rightfully mentioned, the window of opportunity is very short. I think for the, I would say, economists or analysts that were calling for a cut, there was, as I said, a realization that the members are going to be at odds, that it could be now or it could be in November. And if it's not November, you've missed that boat. By the time we get to the November meeting, they will have, I think, a little bit more information. They'll have more inflation prints. And he also mentions in September they're expecting inflation to tick up because of the petrol price. And then I think they would have had enough time to actually take in all of this information and also have a look at the implications of the medium-term budget policy statement and what that means for the rand and implications for the central bank. As I said, it's either November or they've completely missed the boat. And I think that, the risks are quite high and they've had to deliberate and, just balance that.
Would a rate be cut? Would a rate cut made a difference to business and the average consumer, even if it was 25 basis points?
Definitely, because cumulatively it would have been 50, and if you expect, because my expectation was actually that they would front load it, and so we'd see 75 basis points this year, that would, be that would put a lot more sense in consumers' pockets versus not doing anything. I think the risk here is a stop and start, and so they've already cut rates in their previous meeting. I would have expected them to do that now, and now it's this wait and see. That, November is also close to the other risk that we haven't mentioned, that they mentioned as political risk. So you don't want a situation, as Mamela said, where actually you've missed the boat completely and you've just only had one rate cut. And the next move will be rate hikes when those risks start becoming real. So you don't want, we know that already that June is a very important month, only because of also rating agency. We know that also next year is going to be a very important year politically, and it's going to be a lot more noisier than we see now leading up to to December, only because we're leading up to 2019 to the national elections. So you'll have more contestation from all political parties. That's bound to be very noisy. You also have the risks of more increases should inflation reach the US target. We could see more hikes in the US as those economies, US and Europe, as those economies start to strengthen. And those are the risks that we don't want to, that may stifle the possibility of rate cuts. And I think that they really should have cut rates now, and then we would have at least enjoyed the benefits of the rate cut in future in 2018. But having this one cut, and also I think that the excuse of not having put the inflation number in their estimation, in their discussions, in this two-day discussions, is actually a bit disappointing, because we had all forecast the CPI number. We had expected an increase because of the petrol price that was higher, and assuming that because petrol prices are going to be slightly higher because of the currency, you then add that factor in your forecast. So them not doing so is a bit of a strange one to me, and because there's also uncertainty. The uncertainty that we don't have is the electricity price, but that's only next year. So I think the only uncertainty is actually quite far. You knew that petrol prices are increasing. You have that a month in advance. You know that inflation as a result will uptick a bit. You know that food inflation is coming down. You know that meat has been sticky. So I think that nothing is new in terms of what we're seeing in inflation. So I would have expected them to consider those factors and factor them into their forecasting.
What about the rand, Mamela? Let me bring it to you. I mean, he says that's possibly one of the biggest risks to the inflation, and he's mentioned a few things. I mean, the rand being key, he says it's susceptible to political events, and again, there's uncertainty there. There was a question about what the implications would be for a downgrade if you see these capital outflows. What's your take on how he answered that?
I actually didn't catch his response to that question, but I think the rand has been a key risk the whole year, and he's been highlighting in all the statements that we've had this year that this is the biggest upside risk to the inflation outlook. And I think, as he rightfully mentioned, event risk on the political front heading into December and also October is quite high. But I think what we've seen over the past couple of days is that the rand has reacted quite negatively to the rise in inflation in the US and the possibility of a very high possibility of a Fed increase in December. And I think that this is basically going to be what we see throughout next year, because there's 3 rate hikes penciled in by the Fed next year. And also, if we look at the BOE, they're starting to sound quite hawkish in terms of monetary policy. And there is also an increased possibility that, the ECB could increase interest rates next year. So from an international perspective, this time right now would have been great to ease policy because the rand remains quite favorable. But as, time goes by, internationally, internationally the risks are quite high. He also mentioned that the current account has been quite favorable. And if we actually think about it and look at it, terms of trade are expected to peak quite soon, meaning that we're going to see a deterioration in the current account in the quarters ahead. So that support is going to fall off. And then he also mentions credit downgrades. I mean, we've been going on about this for quite some time, that in next year in June there's an increased possibility that we could get downgraded. The sovereign ratings are going to give their reviews in November, and we anticipate that they will wait and get a sense of what the political landscape and the plans are after they get the medium-term budget policy statement and the February budget before they make a decision in June. But as things stand, it does seem as if that downgrade is also pending.
The implications of this outflow of funds, if our local currency does take a knock into sub-investment grade, Tabi, how significant and you think crucial is that event?
It's very significant. It's more so because if, let's say, if Moody's downgrades us, then we're going to basically leave the index, the Citi WIGB index, and that's what a lot of analysts have been looking at. The amount of flows that will come out, and those flows will be in billions. And it varies. We've seen 50 billion to 100 billion. It depends. It's very difficult, I guess, to estimate the outflows because it depends on also what investors are, the investors' tolerance to a downgrade. So those who will have to leave will do it, but then they also will actually, you could join other indices, which, let's say, Citi has. So we could be supported by that in terms of a full-on outflow. Some may like South Africa, and I think we are helped by the fact that our emerging market peers have also been downgraded. So it's a matter of not, I think, weighing up your options. Do you still want to stay in South Africa, or do you want to get out of South Africa and rather go to a Brazil or a Turkey? But I think that we are supported somewhat by the fact that, investors may not want to leave completely. They may want to put their money in other less attractive indices. The problem with South Africa, though, is that it's an election year. So there's a lot of risk that will threaten investors, which in a year that will be loud, noisy. And I think that is negative for investors and negative for South Africa.
Okay, I'm afraid we're running out of time. I'm going to have to leave it there, but thank you very much, ladies, for joining us. From Argon Asset Management, Dr. Tabi Leoka, and Senior Economist at FNB, Mamelo Matinga. I'm told we got an ad break, so we can still check out the growth aspect of all of this. To a break now. When we come back, more analysis.
An exciting opportunity and an absolute must for those with the spirit of adventure is a Kruger Park night game drive.
The railway station itself is already a sight to behold and offers gracious colonial-style buildings and serves as the departure and arrival point for all train journeys.
I wanted to dress with my best color. Being awarded to do the Serpentine Pavilion is the highest commission in my career. And I wanted just to come and show me with my best clothes, and that is blue.
Catch Trends Travel every Sunday from 12 to 1 for all the global travel and leisure trends.
Welcome back. We're still with that analysis of the latest interest rate decision by the Reserve Bank. The Reserve Bank governor announcing just moments ago that interest rates remain steady. The repo rate at 6.75%, which means that your prime lending rated banks remains at 10.25%. With me from Argon Asset Management, Tabi Lioka, and senior economist at FNB, Mamelo Matikinga. Thanks very much indeed. We've got one more section. Let's start by looking at the growth prospects that the Reserve Bank tells us. Basically, it remains the same, Mamelo, just up, I think, 0.1 percentage point from 0.5% to 0.6%. Of what significance is this?
Not much. I think there was a lot of excitement and hype, around the second quarter GDP release. We did see that the economy expanded by 2.5% quarter on quarter. And this is because the base in the first quarter was really horrible. But if we look at the sustainability of that momentum going forward, it is quite clear that if we look at the latest data that we have, particularly retail sales have been released, manufacturing, mining, that has been quite weak, suggesting that the third quarter should report quite weak growth. And if we look at business confidence, which the governor also touched on, we did see that index jumped by 6 basis points to 35, but that's still well below 50, suggesting that businesses are not feeling very optimistic about the current environment. And we're seeing that in the investment numbers that came through in that GDP release, that actually fixed investment activity continues to contract. In fact, the private sector, pulled back even more in the second quarter, and that number was actually helped by government activity. So I think that the data that we have is consistent with an economy that's growing at below 1%. His numbers are more or less in line with ours. As I said, because there's no impetus for economic growth, it's very difficult to see the economy growing above 1%.
Which is why, Tabi, I mean, again, to your point, this period could be used as an opportunity to actually help that growth number, shouldn't it? But it never happened.
Definitely. I mean, I think the period should have been used to stimulate growth, and it hasn't. They haven't. And we're going to struggle. And I do think that the percentage point increase is really very little. I don't think they should have actually increased it. I think that I agree with Mamelo. The third quarter is going to be quite weak. If you look at high frequency data, it points to a much weaker economy. And this reason why we had this increase in the second quarter is mainly because of base effects. And certain sectors rebounded also in the second quarter. But we are unlikely to see that in the third quarter. And also it's going to be very difficult in the fourth quarter. I think that we need to think beyond just percentage points increases. 2.5% is really weak. If you look at the World Bank came out with their estimates, and they revised down our GDP from 1.1% to 0.6%. So we're basically hovering at half a percentage point GDP, and we should really be growing at least 3%. Actually, and above 5% if we were to bring down the very high unemployment rate of 27.7%. So again, we're really just bumping at the bottom. We're still flirting with recession, and anything that could just pull us down, whether it's a slowdown or an unexpected slowdown in mining or manufacturing, that could lead us back into below zero growth.
And Mamelo, do we rely at times a bit too much on the Reserve Bank for boosting growth in the country? I mean, essentially we have a structural problem. But nevertheless, I think that you still have those analysts and many people that look to the Reserve Bank for that impetus. But do we rely too much for growth on the Reserve Bank? I think the reliance on the Reserve Bank over the past couple of years has increased. But it's quite important for us to continue to communicate that that's not their mandate. Of course, a cut in the interest rate would have provided some relief to the consumers, especially your highly indebted consumers. It would have helped in terms of restoring their balance sheets. But I think, as you rightfully mentioned, that to stimulate economic activity, we need to look elsewhere. We need to really address the structural issues that we have. We really need to address this depressed business confidence that we're seeing to ensure that the economy gains momentum. And that business confidence, Tabi, I think 33-year lows. Again, the governor not afraid to mention the fact that political events are still bringing that down. Do we have to wait until this big elective conference in December to see that change?
I'm afraid it's not even just December. I'm afraid that we have to wait till after 2019. We almost have to start afresh in terms of policy, because we're going to adopt a new policy, or the ANC is going to adopt a new policy in December, but we don't know whether that policy will be the country's policy in 2019. Yeah. So that is a big uncertainty. Talking about business confidence, also even consumer confidence, it's going to be very difficult to increase consumer confidence and business confidence at a time when there is a lot of political noise and political uncertainty. And it is unlikely, I don't expect business to invest massively in South Africa when there is this political uncertainty and the noise that we are going to see and get from now till 2019 elections. And again, this will also slow growth. If we don't expect investment to increase, where else are we going to get growth from? I think that the three sectors or areas where we should see growth, or at least a combination, is from the Reserve Bank through stimulating, and that we've already concluded that if they don't front load it, then they won't have an opportunity to hike rates in the latter part of next year. Fiscal policy is supposed to be stimulatory, but again, in an environment where we are cutting the spending ceiling and we have huge shortfalls on the revenue side, that is unlikely to happen. And actually, I fear that we could see increases in taxes as a result, which then does the opposite. It stifles growth. And we also should see business. Business is also a very significant stimulant to the economy. And if investment is not there, we are unlikely to see increases in investment.
Coming off that, Mamela, how important will the midterm budget next month be to business confidence? What are you looking for?
I think, let's keep in mind that the MTBPS is an update of the targets that were set in Feb. So they're just going to tell us where we are relative to what we had anticipated. So as it stands, we have received indication that, the government is going to miss some of their revenue targets. And if one looks at the numbers that we have to date, it does suggest that that shortfall could be around 44 billion. So what will be interesting is to see if they provide us information as to how they plan to plug that shortfall. It could come now or it could come next year. But as Tabi mentioned, it does seem as if there's a real possibility that taxes could go up. The governor also touched on that in the MPC today. So there's a real possibility that we could see tax increases that might also stymie economic growth. The minister did give us his 14-point plan, and he said, there'll be further detail in the MTBPS. So it will be quite interesting to see, how they plan to actually stimulate economic growth, if there's any detail in that MTBPS. I would say the big thing to really look out for would be the February budget, and I think the sovereign rating agencies as well will wait to see what the government's plan is come next year. And
justifiably so, Tabi, because the governor says himself that internationally, I think these were his words, the environment is relatively favorable. I mean, if you look at Europe, you look at Japan as well, all speaking to the fact that the struggle really is domestic, isn't it?
Definitely. And he has a problem with an increasing, or at least an improvement in growth elsewhere, is that leads to outflows. So this is the period where we should be capitalizing on our inflows, capitalizing on the fact that inflation is low, capitalizing on the fact that despite the political noise, we're actually plodding along. We're not in recession. We've just come out of the recession, and I don't think enough is done now. And unfortunately, if we find ourselves in a very difficult position in the quarters ahead, it will be very difficult to come out of it, given that we have fiscal limitations, we have monetary limitations, we're going into a political year. So I just think that this is the time, this is our opportunity to actually capitalize on the inflows and the low inflation. And low inflation we didn't because we didn't cut rates, and we'll see what happens at the NTBPS and what color in terms of or hints that they would have, because even though they don't give detail on taxes, we will get an idea, given that we are currently below the targets or not at target. So it just will be interesting what they say, and it will just also give us a picture of what to expect in future.
I've got a few seconds left, Mamela, so I'm going to end with you. Just judging from what you spoke to me about a few seconds ago, do you suspect that we've seen it? That's it. We're not getting cuts in the near term for now. The fact that the governor this time around didn't emphasize if we are still in this cutting cycle,
is a bit of a cause for concern for me, because it does suggest that actually they're not committing to anything right now. They will wait and see.
I'm going to have to leave it there, ladies. Thanks very much indeed. That's where we ended. From Argon Asset Management, Thabi Leoka, and Senior Economist at FNB, Mamelo Matinga. Thanks very much indeed for talking to us. All right, that's where we leave it. More details on the story in our later bulletins.